Types of investment, forms and ways to invest. Investing. The term investing intimidates a lot of people, but it really should not. Yes, there are various options and it can be hard to figure out which investments are right for you and your personal financial situation. In general, however, investing is the process of buying assets that hopefully, over time, increase in value and, therefore, provide returns in the form of income payments and/or capital gains. In a wider sense, types of investment. There are many different types of investments available in the financial market. The most common are shares, bonds, mutual funds, real estate investment trusts, commodities. Which investment form you choose depends on how much money you can and want to invest, the time frame, and how much risk you're willing to take. Beyond the amount available and your stance toward risk, the selection of an investment that may be right for you also depends on your personal circumstances and your ethical values. For example, which industry you want to support with your investment. Shares. Shares, also stocks or equities, are the best known and easiest to understand type of investment. When you invest in shares, you are buying an ownership stake in a publicly traded company. You hope that the price will go up so that you can sell the shares for a profit. Of course, there's also the risk of falling share prices. You might end up losing money. Investing in shares of just one company is usually not a good idea. It is better to spread the risk by investing in different securities or companies, also in different industries or countries. This is called diversifying. Bonds. Bonds are a form of securities that work similar to loans. When you buy a bond, you're basically lending money to an entity. The entity can be a large company or a government. Bonds of companies are called corporate bonds, while bonds of governments are called treasury bonds. Both entities issue bonds because they want to borrow money for a certain period of time, also known as term of maturity. You can buy bonds when they are first issued or offered, or at any point during the term of maturity. The bond's price is subject to fluctuation according to supply and demand. In most cases, the borrowed money is paid back at the end of the term of maturity. Until then, the lender gets regular interest payments. The rate of return for bonds is typically much lower than for stocks, but bonds tend to be lower in risk. Yes, the company you buy a bond from could go bankrupt or the government could default. In general, however, treasury bonds, notes and bills are considered a very safe investment. Mutual funds. A mutual fund is a pool of money from many investors that is invested diversified in a number of companies. A mutual fund can be managed by a fund manager who decides in which securities the money is invested. On the other hand, there are mutual funds known as index funds which simply track a major stock market index. In general, mutual funds invest in a vast and diverse array of securities, equities, bonds, commodities, currencies, or derivatives. Mutual funds bear much of the same risks as stock and bonds. However, due to diversification, the risk is often considered to be lower. Real estate and real estate investment trusts, REITs. Real estate investment trusts, also referred to as REITs, are companies that invest in all kinds of income-generating real estate. Investing in real estate is a long-term and stable choice because under normal circumstances, property does not suffer significant losses in value. This makes it a safe investment, particularly in times of crisis. Investing in real estate yourself is also a good idea. You can always find people who want to rent from you. And rental revenues are usually well suited for long-term planning. A major advantage is that you can later use the property yourself, for example, when your children move out, or just sell it. Compared to an investment in securities, investing in real estate will bring about additional expenses. Costs arise not only when you purchase or sell real estate, but continuously for maintenance and utilities. Commodities. Commodities are physical products in which you can invest your money. They are common in special stock markets, derivatives market, where producers and commercial buyers try to hedge their financial interests. When investing in commodities, It is essential to understand how this financial instrument works. Commodities are subject to very sudden and substantial changes in price in either direction. For instance, some political action can massively affect the price of crude oil, and weather can impact the value of agricultural products. There are four major types of commodities: precious or industrial metals such as gold, silver, or copper; agricultural products such as corn, wheat, or soybeans; livestock and meat such as goats, sheep, or beef; energy such as natural gas or crude oil. Investing versus speculation. Many people mistakenly assume that investing always means speculating. Whether something is an investment or a speculation depends on three factors: the amount of risk taken, the holding period of an investment, the source of returns. Investing usually involves less risk than speculating. The holding period of a financial instrument is longer in the case of investments. Profits are mainly derived from dividends. When speculating, a financial instrument is usually held for only a short period of time. Profits are made from short-term price appreciations. Here are some action steps. Thank you for your attention. Congratulations, you have completed this topic.